Your mortgage payment just increased by $2, $3, maybe $400 a month, and your interest rate didn't budge an inch. You didn't refinance, you didn't miss a payment, and you definitely didn't sign up for this. Ever wonder why your lender gets to reach into your bank account and demand more money, even though nothing about your actual loan changed? Today, I'll explain escrow like you're 5 years old. By the end, you'll understand exactly why this happens and what you can actually do to fight back or avoid it altogether. Here's what escrow actually is. Think of it like a piggy bank your lender controls. Every month, part of your mortgage payment goes into this account to cover property taxes and homeowners insurance. Your lender sits on that money all year, pays those bills when they're due, then recalculates what you need to contribute next year. Except here's the catch. When property taxes spike because your home value went up, or your insurance premium doubles because climate disasters made your zip code a liability, they pass it straight to you. You don't find out until months later when you open that escrow analysis letter and realize your payment just went from $1,800 to $2,200. No warning, no negotiation. Just pay up or we'll start the foreclosure clock. Now here's where it gets wild. You're actually getting hit with two separate shocks at the same time. Shock number one. Your property tax or insurance bill legitimately increased. Your county reassessed your home value and decided you owe more tax. Or your insurance company looked at wildfire maps and hurricane patterns and decided your premium needs to jump 40%. That's not your lender's fault, but it's also a bill you never shopped for, never approved, and couldn't easily avoid. Shock number two is the escrow shortage. If your escrow account ran low because the bills were higher than your lender estimated, they raise your payment even more. They need to catch up on the deficit and rebuild their safety cushion. So you're not just paying the new higher amount going forward, you're also paying back what the account was short, spread over 12 months. This matters because escrow isn't optional for most people. If you put down less than 20% when you bought your home, your lender almost definitely required an escrow account. You don't get to manage those bills yourself. Your lender controls the money, decides when to pay, and adjusts your payment whenever they feel like it. And here's the kicker. That money sitting in your escrow account, the lender keeps every dime of interest. You're giving them an interest-free loan every single month so they can guarantee their collateral stays insured and doesn't get seized for unpaid taxes. But here's what most people miss about how the shortage calculation actually works. Your lender is required by federal law to keep a cushion in your escrow account, typically 2 months worth of payments. When your taxes or insurance increase, that cushion amount also increases because it's based on the new, higher bills. So your payment doesn't just go up to cover the increased costs. It also goes up to rebuild that larger cushion. This is why a $300 annual increase in your property tax bill can translate to a $30 monthly payment increase instead of the $25 you'd expect. Let's talk about what you can actually do. First step, request your escrow analysis statement if you didn't get one automatically. Federal law requires your lender to send this annually. It breaks down exactly what they paid for taxes and insurance, what they're projecting for next year, and how they calculated your new payment. Read every line like you're auditing your own company. Go to your county tax assessor's website and verify those numbers. Pull up your actual property tax bill and compare it carefully. Errors happen more often than you'd think. Sometimes they overestimate to build a bigger cushion, which inflates your payment unnecessarily. Next, call your insurance company and demand to know why your premium increased. Don't just accept the number, ask what changed. You absolutely can shop for homeowners insurance. Get quotes from at least 3 other companies and compare them carefully. If you find a better rate, and you probably will, switch immediately and notify your lender. Insurance companies love jacking up prices for loyal customers while offering deals to new ones. Send proof of the new policy to your lender, and they're required to adjust your escrow account and recalculate your payment. I've seen people drop their monthly payment by $50 to $100 just by spending an afternoon getting quotes. Property taxes are tougher because you can't just shop for a new county government, but you're not completely powerless. If your home was recently reassessed and the value seems inflated compared to similar houses in your neighborhood, you can appeal. Most counties have a formal process. You'll need to gather comparable sales data proving your home is worth less than they claim. It's tedious and doesn't always work, but if your assessment is genuinely wrong, you could save hundreds or thousands annually. Here's the nuclear option. Ask your lender about an escrow waiver. If you have at least 20% equity in your home and a solid payment history, some lenders will let you cancel escrow entirely and manage taxes and insurance yourself. You'll need discipline because those bills come in giant lump sums. No more spreading it across 12 months. You'll need to save on your own and actually pay on time. Because if you miss a tax payment, the county can put a lien on your house. And if you let insurance lapse, your lender will force place their own policy at triple the cost. But if you can handle it, escrow waivers give you control back. You decide where to keep the money. You earn the interest. You shop the policies. Here's what you need to understand about why this system exists and who it actually serves. Escrow was designed to protect lenders, not homeowners. Banks don't want to risk you forgetting to pay property taxes and having the county seize the house, or letting your insurance lapse and having the place burn down uninsured. They need that collateral protected, because if you default, they're selling it to recoup their money. So they built a system where they control those payments. For you, it creates a situation where you're blindsided by bills you didn't directly choose, paid months in advance with zero benefit, managed by someone else with no transparency, and adjusted whenever they decide with almost no input from you. You're not earning interest on that money. You're not getting a say in when bills get paid. And when it all goes wrong, you're the one scrambling to cover a $300 monthly increase you didn't budget for. The worst part is how it shows up. You're cruising along, making the same payment every month, thinking you've got your budget dialed in. Then boom, letter in the mail. Payments going up. Effective next month. Start paying more or we'll consider you delinquent. And when you call to complain, they hit you with jargon about cushion requirements and shortage calculations. And you hang up more confused than when you started. Some people argue escrow is good because it forces you to save for big bills you might otherwise forget. Fair point if you have zero financial discipline. But for most adults who can manage a checking account and set a calendar reminder, it's just another layer of control that benefits the bank more than you. It guarantees they get paid. It guarantees their asset stays protected. It doesn't guarantee you get the best insurance rate, the most accurate tax estimate, or any transparency into how your money is being managed. So here's where we land. Escrow is a forced savings account your lender controls to pay property taxes and homeowners insurance. When those bills increase, your payment spikes months later with little warning. You're hit with two shocks: the actual increase in taxes or insurance, plus an escrow shortage that makes you pay back what the account was short while also building a new cushion. You can fight back by verifying the numbers on your escrow analysis, shopping for cheaper insurance, appealing inflated property tax assessments, and potentially requesting an escrow waiver if you have enough equity. The system is legal, it's standard, and it's designed to protect your lender's collateral, not to protect your budget. To recap, your payment jumped because taxes or insurance increased and your lender passed the bill to you. Escrow hides the true cost until it's too late to prepare. Check your escrow statement, verify every charge, shop your insurance hard, and consider an escrow waiver if you qualify. The system works exactly as designed, just not for you. So here's what I want to know. If you could choose between managing your own property tax and insurance payments, or letting your lender handle it through escrow, which would you pick and why? Drop your answer below and tell me if you think escrow protects homeowners or just protects banks.